For over 5 decades, Japan has been one of the most loyal financial partners to the United States, quietly holding over $1.18 trillion in U.S. Treasury securities. In fact, Japan is the largest foreign holder of American debt, even surpassing China, the UK, and every other nation. But what if I told you that this long-standing relationship is now starting to unravel? Japan, for years, has been borrowing yen at near zero interest rates and using that cheap money to flood the American financial system. From stocks to bonds and even real estate, Japanese investors have propped up U.S. assets, helping to keep interest rates low and fueling the rise of asset prices. This practice, known as the yen carry trade, has been the unsung engine of the U.S. economy, allowing the country to run massive deficits with little consequence. But something huge is changing in December 2025. The Bank of Japan, once the cornerstone of this financial support, is considering raising interest rates for the first time in decades. When this happens, it will trigger a massive unwind of the yen carry trade. As Japanese investors start to pull out of US markets, the ripple effect will be felt across the globe. Stock prices will plummet, bonds will sell off, and the dollar will take a beating. What does this mean for you? The US dollar is facing its biggest test in history, and Japan just fired the opening salvo. The dominoes are starting to fall, and if you're not prepared, you could get caught in the crossfire. Stay tuned as we dive deeper into what's really happening with Japan's plans and how it could bring the US dollar crashing down. For over 2 decades, Japan has been a silent yet crucial player in the global financial landscape. And the key to understanding their influence lies in the yen carry trade. What exactly is this trade, and why should you care? Let me break it down. In simple terms, the yen carry trade involves borrowing yen at near zero interest rates, and then using that cheap, borrowed money to invest in assets with higher returns, particularly in the US. This trade has allowed Japanese investors to flood into American markets, stocks, bonds, and real estate, pushing prices higher and keeping interest rates low. It was almost like a secret money printer, running quietly in the background, propping up US asset prices and helping the US maintain its financial dominance. At its peak, this trade was trillions of dollars deep. Imagine, Japan had been sending vast amounts of capital across the Pacific Ocean, taking advantage of their cheap yen to buy up US government bonds and corporate stocks. A steady flow of capital that helped fuel the American stock market's rise and allowed the US government to run massive deficits with very little backlash. As Japan kept interest rates low, the yen remained weak, which, in turn, helped sustain the flow of investments into US assets. But here's the twist. Japan's central bank has announced a change. The days of ultra-low rates may be coming to an end. In December 2025, the Bank of Japan hinted at tightening monetary policy. And when they do that, the carry trade will begin to unwind. Investors will start selling off US assets and converting their dollars back into yen, putting massive pressure on the dollar and American markets. This isn't just a minor shift, it's a potential financial earthquake, and it's coming faster than you think. December 1st, 2025 was the day that financial markets around the world held their breath. Bank of Japan Governor Kazuo's statement sent shockwaves through the global economy. After years of maintaining negative interest rates, Japan was finally considering tightening its policy. And just like that, global markets reacted immediately. The probability of a rate hike shot up from 58% to 76% overnight, and within hours, the yen strengthened dramatically. Japanese government bond yields spiked to their highest levels since 2008, and global investors began to feel the first tremors of what could be a monumental shift in the financial world. What Japan does next, especially regarding its rates, could redefine the future of the global economy, including the US dollar. Why does this matter? For nearly 2 decades, Japan's ultra-low rates have been a stabilizing force, feeding trillions of dollars into the US markets. The yen carry trade was a key part of this system. When Japan raises rates, that flow reverses. Investors will no longer want to borrow cheap yen to buy US assets. In fact, they'll be forced to sell off some of their US holdings to repay those loans. This massive unwinding of the carry trade is like a tidal wave crashing into the US financial system. We've already seen a preview of the fallout. When the Bank of Japan raised rates even slightly back in August 2024, the Nasdaq 100 plummeted 13% in less than a month. That was just a small move. Imagine the consequences if Japan follows through with multiple hikes. The ripple effects on US markets and the dollar could be catastrophic, and we could see a situation where the dollar no longer maintains its dominance. As Japan continues to normalize its monetary policy, a new threat looms over the US dollar: Japan's massive sell-off of US Treasury bonds. In 2024, Japanese investors sold a record $61.9 billion in US Treasury securities in just one quarter, marking the largest quarterly sell-off ever recorded from Japan. With Japan dumping an additional $227 billion worth of US government bonds. US Treasuries are not just investments, they're the backbone of the global financial system. For decades, Japan has been the largest foreign holder of US debt, with over $1.18 trillion invested in these bonds. Japan's actions carry immense weight. When they start to offload these securities, the entire world notices. The psychological impact is profound. Investors everywhere start asking questions. Why is Japan selling such vast amounts of US debt? What does it mean for the future of the dollar? What happens if other nations follow suit? When Japan, as the largest foreign holder of US debt, it creates a cascading effect. Other nations start to question the stability of the US financial system, and that leads to a decline in demand for US bonds. As demand drops, yields rise, and the cost of borrowing for the US government spikes. This vicious cycle continues as the government must offer higher yields to attract buyers, further increasing its debt load. We're witnessing the beginning of a dangerous trend, one that signals the end of the US dollar's dominance. The very foundation of America's financial hegemony is at risk. For decades, the yen carry trade has been one of the most powerful and widely used financial strategies in global markets. Japanese investors borrowed yen at near-zero interest rates and used that cheap money to flood into US assets, stocks, bonds, and real estate, driving up American asset prices and fueling economic growth. This trade created a massive flow of liquidity, propping up the US economy and keeping interest rates low. But now, the yen carry trade is unwinding with incredible force. The reason? Interest rate hikes in Japan. For years, Japan kept rates at or near zero, which allowed investors to borrow cheaply and flood the market with capital. But on December 1, 2025, Bank of Japan Governor Kazuo Ueda shocked global markets when he announced that Japan would consider raising interest rates. This announcement sent shockwaves through the markets. The probability of a rate hike surged from 58% to 76% overnight, triggering a chain reaction in global markets. As Japanese rates rise, the cost of borrowing yen increases, and the yen strengthens against the dollar. This reversal of the carry trade forces investors to unwind their positions, selling off US assets and converting their dollars back into yen. The result? Massive selling pressure on the US stock market, US bonds, and the dollar itself. The impact of this is already being felt. In August 2024, when Japan made its first surprise rate hike, the Nasdaq 100 fell by 13% in less than a month. The yen surged by 14% against the dollar, sending shockwaves through global markets. Now, as Japan continues its rate hikes, the unwinding of the yen carry trade will put increasing pressure on US assets. This is a tipping point. The US economy, built on cheap foreign capital, now faces a new and profound risk as Japan's policy shift pulls the rug out from under the dollar. In addition to the unwinding of the yen carry trade, there's another seismic shift happening in global markets: Japan's massive sell-off of US Treasury bonds. This, too, is a direct consequence of Japan's tightening monetary policy. For years, Japan has been America's largest foreign holder of US debt, holding over $1.18 trillion in US Treasury securities. This massive holding has been a stabilizing force for the US financial system. Japan's buying of US Treasuries has allowed the US to run massive deficits and keep interest rates low. Japan has played a crucial role in propping up the dollar and funding American debt. However, that's changing. In the third quarter of 2024, Japanese investors sold a record-breaking $61.9 billion in US Treasuries. This was the largest quarterly sell-off ever recorded from Japan. The trend continued into early 2025, with approximately $227 billion in U.S. government bonds sold. This isn't just about the size of the sales, it's about the psychological impact. When Japan, the largest holder of U.S. debt, begins to sell off its Treasury holdings, it sends a signal to other investors that U.S. debt may no longer be the safe haven it once was. This is a critical moment for the U.S. The Federal Reserve is caught in an impossible position. It needs to maintain high interest rates to defend the dollar, but those high rates are pushing away foreign buyers of U.S. debt. If demand for U.S. Treasuries drops, the U.S. will have to raise interest rates even further to attract buyers, which risks triggering a deep recession. This is the unraveling of the dollar system, and Japan's sell-off is accelerating the process. The balance of power is shifting, and it's happening right now. While Japan's actions are sending shockwaves through global financial markets, there's an even bigger movement happening behind the scenes that poses an existential threat to the U.S. dollar: the rise of the BRICS nations. BRICS, Brazil, Russia, India, China, and South Africa, are quietly working to undermine dollar dominance and shift global trade away from reliance on the greenback. For decades, the petrodollar system has been one of the pillars of U.S. dollar supremacy. The idea was simple. Oil exporters, like Saudi Arabia, agreed to price their oil in U.S. dollars, and in exchange, the U.S. would provide military and economic protection. This created massive global demand for U.S. dollars, as countries needed them to buy oil. But now, this system is beginning to fray. BRICS nations are accelerating efforts to trade in local currencies. China and Russia are already conducting over 90% of their bilateral trade in their own currencies, bypassing the dollar. India has signed agreements with countries like the UAE and Indonesia to trade in local currencies rather than dollars. Even Saudi Arabia, once the poster child of the petrodollar system, is in talks to price oil in yuan, euros, and yen. On top of this, BRICS is aggressively building an alternative payment system, one that will bypass SWIFT, the messaging system that underpins the global financial system. BRICS is also accumulating gold reserves at an unprecedented pace. In 2024, central banks added 1,045 metric tons of gold, marking the third consecutive year over 1,000 tons. This is a clear signal that the world's biggest economies are preparing for the future without the dollar. The shift away from the dollar is not just a slow trend, it's accelerating. If the momentum of de-dollarization continues, the U.S. will find itself in a global financial environment where the dollar is no longer the dominant reserve currency. And when that happens, the U.S. economy will face massive consequences, from higher inflation to a weaker global standing. The writing is on the wall. The U.S. dollar is at the precipice of a transformation, and Japan's moves, alongside the accelerating BRICS de-dollarization, are just the tip of the iceberg. What we're seeing today is not just a temporary blip, it's the beginning of a seismic shift in the global financial system that could change everything we know about wealth, security, and economic power. But here's the good news. You don't have to sit idly by while this unfolds. The world may be changing, but you can adapt and protect your financial future. There are actionable steps you can take today to secure your wealth against the fallout that's coming. It won't be easy, but the sooner you start, the better your chances. First, diversify your assets. Don't rely solely on the dollar. Invest in gold, silver, and other hard assets that have held value for centuries. They can protect you from the inevitable fallout of a weakening dollar. Additionally, consider foreign currencies as part of your portfolio. Countries with strong economies and stable governments, like Switzerland or Singapore, may provide a safer store of wealth. Second, rethink your investments. The U.S. stock market, especially in the tech-heavy S&P 500, is dangerously reliant on a small number of mega-corporations. As we saw in the previous sections, the risk is growing. Look for alternative investments. Real estate, emerging markets, and commodities could offer a more stable return. Finally, stay informed and proactive. This isn't a time to be passive. Follow the global shifts closely and adjust your strategies as the situation evolves. Don't rely on promises of stability from the government or the financial establishment. Take control of your own financial destiny. The dollar's biggest test is here, and if you wait until it's too late, the consequences could be catastrophic. Stay vigilant, stay prepared, and don't let this moment pass you by. The clock is ticking.